You're going to see here, if you're here on the open, you're going to see a moment. If you're looking to get short, what do you look for? You look for longs to come in. Let me back this up. Longs to come in and shorts to puke. If you're looking to get short, you want less shorts. Well, on our puke tool, you see a lot less shorts. That's this red. They puke, they exit. The biggest one of the last 8 hours. And this green shows new longs entering. Let me roll it down to here. You also could see it right here. New longs entering and all these shorts puking. And the market comes off, comes back in, boom. Longs come back in again. And now you're going to see these go away, which is really the kicker. You have to be looking for this, anticipating this, so that when you see it, you could react. Yeah, it's important to see stuff after it happens? Of course. It's even more important to anticipate what's going to happen. So you could see this. Wait, right there. Let me back it up even more. Watch the reds disappear. And you see my mouse going crazy showing people it in real time. The reds disappear, and then they really disappear a lot in here. So you had them puke coming up in this area. You had the longs entering, and when longs are stuck and you get below them, they're the ones that create the sell pressure when we do go down. That's where that comes from. And we zip down to a couple targets. One was above where some stuck shorts were prior, and then the other one was right at 46 half. Why 46 half? Because we had stuck shorts on the way up. And the market comes down to it and bounces from it right there. So I'm not trying to oversimplify trading, but if you're looking to get short and you're looking for, well, you should be looking for less shorts and more longs to create more sellers and less buying, because that's what you need for price to go down. Let me just write this up really quick, because I cannot say this enough. For price to go down, for anything, for the price of anything to go down, you need the dynamic of less people willing to buy that product. So less people to buy it are less buyers. And it would help a lot if you had more people willing to sell that product, wouldn't it? So less buyers and more sellers, that's the dynamic that you need. Not that you want, not that would be helpful, but that's necessary for the price of anything to go down. Less people willing to buy it, more people willing to sell it. Price of anything will then go down, correct? Now, how do you get there? Because in order to make money on something, you have to predict it happening before it happens. You can't say, hey, it's going to rain after you felt a bunch of drops. There's not a lot of value there. So how do you predict price? And a lot of people are trying to predict price with price. Try to predict price from now on by how do you get here? How do you get there? How do you get to the moment where you think you have less buyers below and more sellers above? Because that's what's going to give you the probability of direction. So this is what you're trying to predict, when that dynamic's going to occur. Not after price moves down, it's weak. You're trying to get to here. How do you get to there? If you're looking to sell the market and get short, which is what you would be doing if you are bearish, right? You got to get to here to qualify your entry.